together our investment decks for our investors, I can really explain the story of the property and the management approach and strategy fluently to our investors because I've been on that ground level and been through the operational trenches.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Ballara, and this is the Know Your Why podcast. Today I'm here with Peter Richter. Peter provides strategic direction on matters affecting investor communication, capital markets, equity placement, and functions as a liaison to new investors. Peter, you do have a very diverse background. I kind of want to let you tell the story, but before we dive into that, let me just say thank you. Thank you for taking the time out. I really do appreciate it.
Definitely. Jason, thank you for having me on. I've been a big fan of your podcast for a while and some of the stories I've heard on it, so it's an honor to be here.
Thank you. Appreciate that. Well, let's start with your story. Let's talk about kind of your background, and we can kind of move through it and what you're focused on today. And I'm sure I'll have lots of questions.
Sure. Well, I guess we'll start from the beginning. I have a little bit different genesis than a lot of people in my space and my level. I began my career as a leasing agent for apartments here in San Diego. It was 2012, 13. The economy was still feeling the aftershocks of the GFC. So jobs for recent graduates were few and far between, and in some cases unpaid. So when I found a job leasing apartments for a local operator here in San Diego, I jumped on it. From there, I learned the basics of property management, and soon I took a position with a West Coast merchant builder, and operator, Holland Partner Group. They're a big presence on the West Coast, specifically here in San Diego and LA. There, I learned that was my first introduction to multifamily, specifically, and like institutional grade multifamily. Mm-hmm. I was hired as an assistant manager. Soon I took another job with Pinnacle International as a manager of a high rise down here in San Diego. And then fast forward about 4 or 5 years, I was managing for UDR, one of the larger residential REITs in the country. And I was managing the entire San Diego portfolio. It was there where I got my first taste of kind of investor interfacing. It was the portfolio was part of a JV with MetLife, and it was my duties to kind of convey the operational status to our JV partners. So that's where I really got my first introduction into like investor relations, per se. And then after that, I started working for a local syndicator here in San Diego, Davlin Investments, and there I was the director of asset management and investor relations. And that's the first time I really transitioned from property management to asset management and further direct investor relations. Fast forward a few years, and here I am as the director of capital markets and investor relations at InterWest Capital. And InterWest Capital, I think, is different from all my prior experiences. That we are nationwide. We have our target markets we like to invest in, but we are opportunistic in nature, and in some cases agnostic to the market as long as it has strong underlying fundamentals that we look for, which has been great. I now work on a variety of different projects, markets, asset classes, and with a variety of different investors. So we work with everyone from private retail investors to family offices to some of the largest institutions in the country. Each of those different, let's call them investor classes, requires a little bit different approach and often require different returns. So I've gotten and have different investment preferences. So I've gotten a lot of exposure in that sense working here at InterWest.
Yeah, that's really fascinating background. I don't know if I've had anybody on here. I know people that have become, sort of vertically integrated. I know people that have worked in property management before, but I guess, starting as that leasing agent, it
Yeah.
definitely, I'm sure, gives you a very unique perspective. I think I look at, and I want to dive in on the topic of, sort of property manager versus asset manager, because I think that's an important distinction for people. But I would say one of my, I guess, observations has been that there's kind of three distinct categories in my mind between like property management, in a lot of ways asset management as well, but with the leasing being one of them, right? So
Mhm.
I think there's leasing, I think there's construction management again, and then the to me the financial management kind of
Sure.
combines that's how I've been able to sort of make it work in my mind. But I
Right.
wanted to kind of get your take on just that sort of start as a leasing manager and how that's helped you kind of going forward in your career.
Definitely. Starting as a leasing manager and before that a leasing agent is you really get a intimate understanding of tenant preferences, tenant and different what makes a unit lease. Whether it's south facing, now when I'm looking at deals, we're doing a 200 unit deal right now in Chattanooga. I'm diving into the unit mix, and as the unit mix is skewed heavily towards 3 bedrooms, I know it's going to be more attractive to families per se, which
Right.
means the school district in the area will probably carry a little bit more weight, and for that reason, we might be able to charge a premium over our competitors. It's those kind of insights, and that was a simple one, but we do a lot of value add here, and it's through leasing I learned what are tenants really looking for as far as renovations, and what different economic what different price points. Workforce housing, it might someone a tenant a prospect who's looking at workforce housing may not care if it's quartz or granite. But on
Right.
a Class A, which I've managed both, I've managed some of the nicest high rises in downtown San Diego. People really care. People care, what brand their refrigerators are, not just if it's stainless steel, but is it Whirlpool or is it Sub-Zero? Understanding those kind of tenant preferences makes a big difference when executing a renovation strategy on a large scale. And further, as part of my job, I put together our investment decks for our investors. I can really explain the story of the property and the management approach and strategy fluently to our investors because I've been on that ground level and been through the operational trenches.
Yeah, that makes a lot of sense to be to have come, as you said, from the trenches and just be, and that's funny because you say that's how I feel a lot about my construction background is I came from
Mm-hmm.
doing construction like as a teenager. And so the construction side of things, I can easily communicate with both the contractors and vendors and then, up through the investors to kind of explain what's going on.
Mm-hmm.
And I think having that on the leasing side certainly is going to be beneficial in explaining the story when you're talking to investors about a specific deal, what you like about it.
Definitely. I think it also gives you a competitive advantage, Jason. I mean, when you're looking at your competitors who haven't been on a construction site working, they might, having that, again, that like deep insight into the process. I think it gives you a competitive advantage of over people who are just, desktop underwriting and
Right.
putting something together in an Excel model.
Yeah. Yeah. And it just gives you options. It gives you, I mean, I'd like to think that people don't take advantage of other people, but in reality, it does keep you from being in a scenario where a contractor is going to tell you one thing that might not be,
So,
uh, you know, absolutely needed, or it might not be, the right pricing around it. It gives you some background knowledge there to have those conversations. As you sort of moved through that journey and you went from, you know, leasing agent, leasing manager, and then kind of switched to asset manager. Can you maybe just describe for people listening what that means to you, like your definitions and kind of the difference between the two?
so that's probably for me was the biggest pivot is moving from property manager to asset manager. And again, it was portfolio manager to asset manager. But the difference is an asset manager is able to take a step back and look at a operation, a deal from 30,000 feet, whereas a property manager is responsible for, the interviewing, the time cards, managing personnel, approving vendors. The asset manager, a good asset manager, lets the property manager do that and is able to step back and kind of, strategically move the pieces as they see fit to optimize the performance of the investment. And that's another thing is I believe that a property manager's job is to keep the property in line with their budget. The asset manager's job is to keep the budget in line with the pro forma. And I think that's the big distinction is the asset manager has a fiduciary obligation to the investors who will receive the pro forma of how the property is supposed to operate. And it's their job to steer the budget to be in line with that. Whereas the property manager is just more focused on keeping the operations in line with the budget that's provided to them or that they work on. Of course, they work on them.
Yeah. Yeah. I've actually never heard it put that way, but I love that sort of definition because like I said, I think maybe this is the thing that, it's just fascinating, the way people's different backgrounds kind of give you a perspective on things. But that's why I really feel like I broke all that down into, sort of asset management to those three categories. And you mentioned the budget and it's a really good way to look at it from an understanding of what your property manager, how they see the budget versus how you see the budget and figuring out how to, you've got to make those mesh somehow to have the project work. So I like how you kind of pointed that out there. You've journeyed into, kind of asset management and investor relations kind of along the way. It seems like mostly in tandem, those two things went kind of hand in hand, it sounds like.
Yeah, it happened really fluidly. I was the asset manager at Davlin Investments, and it soon became evident that I was the best candidate to, explain the give updates on the status of a property to our investors. And then on new acquisitions, I got very involved in the acquisition process. And then who's going to put together the investment deck? Well, it made the most sense for me to do that. And so soon I just kind of absorbed that role and at my prior job. And I really found I took to it very quickly. Again, I made the differentiation between my experience and a lot of other of my competitors. I mean, a lot of asset managers, for example, not all, and not here at InterWest, but I know other asset managers that are, they're great with Excel, but they've never, they might have difficulty communicating efficiently with investors. I think probably from my years of leasing and managing a team of 40 when I was at UDR, I became proficient at communication and my experience interfacing with our JV partner. So I was pretty good at communicating that story of the properties of the investments to our investors. So it only made sense. If you were going to have both roles, at least in my prior company, if you were going to have both roles, it would have been redundant.
Yeah. Yeah. It really, if you're a decent communicator, it does make sense for that asset manager to be at least intimately involved in investor relations and communications, because you are the one that you're essentially telling, you're building the story, and then you've got to convey it to the investors. So it does make a lot of sense. You may have people on the team that are helping you building those decks or whatever the case may be, but at the end of the day, the person who's involved most on that sort of day-to-day level is who's going to probably be best equipped to relay that to someone else. So it does make a lot of sense that they would be kind of in combination. You mentioned at InterWest you're agnostic. You mean markets, asset classes, maybe all of it?
So when we said, I want to kind of walk that back a bit. I said market agnostic. I think that we have our target markets. And for example, we like what we call, the smile states. So California through the Southwest, through the South, and kind of up through the Carolinas. Those are target markets. But it wasn't 4 months ago I was working on a deal, a high rise in downtown Chicago. It was a screaming basis. It was a distressed seller. So I would say not that we're market agnostic, we're opportunistic. If a good deal comes along in a market that we're at least familiar with. Further, there are markets that we like, such as Phoenix. We own in Phoenix, Austin, and Nashville are markets that we like. However, the supply story in all those markets is there's a just tremendous amount of incoming supply over the next, let's call it 8 quarters. So for us to chase a deal in one of those markets, I guess Phoenix a little bit different, but for Austin and Nashville, we're not necessarily chasing deals in those markets. However, if we found a great deal on a new property at a meaningful discount to replacement cost in a great location, and we were able to underwrite conservatively, as we always do, then that was something we'd pursue. So when I say agnostic, I guess I meant we're opportunistic if something comes along in maybe not a target market of ours.
Yeah, and that makes total sense. I guess with that, it's all multifamily, correct? You're not, or are you looking at other asset classes as well?
So again, I think that goes back to our opportunistic nature. We own 3 hotels. We sold one recently. We own a golf course in Phoenix.
It's a good place to own a golf course.
It is, and it's really we bought it, and we are actually. Our plans are to develop the driving range into multifamily. So again, opportunistic play. Surprisingly, we've owned it for 3 or 4 years, or 4 or 5 years. The golf operations have been doing great. Definitely got a huge COVID boost. So it's cash flowing pretty nicely. Although it's really just covered land play. It's doing pretty good. So again, we do own some hotels, but our core competency and focus is multifamily.
Yeah. And you mentioned value add. Are you also, I know you just said you're thinking about development on the driving range. Are you doing development at all otherwise, or
yeah, I would say if our firm is somewhat opportunistic, our development approach is very opportunistic. We have 3 sites here in San Diego. We just broke ground on one in October. It's going to be a 147 unit multifamily mid-rise. We've got 2 other sites that are at varying stages of pre-development. So we do some development, but it's very opportunistic, and we're not actively chasing new development sites. Most of our efforts, especially from our acquisitions team, is focused on value or multifamily. But now we're doing, we do some value add, some core, we call it restore to core, basically a core plus deal. You can do some light renovations and touch ups and get it in line with core product. We're also seeing opportunities right now with core assets, core plus assets that where the seller is having some significant distress, and we're able to come in at a great basis, far below replacement cost in strong markets. So yeah, value adds our main objective, but we're kind of keeping our eyes on the board.
Yeah, I think it makes a lot of sense. I mean, I think at the end of the day, I heard someone else say this, but at the end of the day, you're in the business to provide returns to investors. Ultimately, that's exactly it. And so finding good deals that work and are financially beneficial to you and your investment partners is the name of the game. And I think that's right. Especially with when market cycles shift, and they shift locally, right? So you may have a downturn in one market and another is kind of on the upswing or something. If you're saying I only invest in this market in this type of asset, you're going to probably miss some opportunities. So I think it makes a lot of sense to kind of approach it the way that you do.
Definitely. It is challenging, I will say, when I'm working with investors, especially institutional investors, and they want to know our strategy. And they say, okay, well, what's your investment thesis or strategy? It's a little bit more difficult communicating that opportunistic strategy to them However, we've got a 20-year track record with average IRRs for multifamily, it's like mid 30s. So I think that we're able to point to our track record, but we also will do some like debt purchases as well. So again, we have a broad strategy, and it becomes challenging when some investors want to see, a very acute, focused strategy. But, my counter argument to that is, if somebody has an acute focus, strategies come in and out of feasibility with market cycles, as you mentioned. And, the typical value add play that people were doing, in 2019 using floating rate debt, that doesn't play anymore. That doesn't work. So if you're still hyper focused on that strategy, they're, I don't want to say out of business, but it's tough.
Yeah, you have to pivot some. It doesn't mean you get away from your, core competencies and fundamentals. It just means you might apply them somewhere else, whether that's a different market or a different asset class. Like, it's not tremendously different to buy a value add multifamily asset as it would be to develop one from ground up, and in the sense that at the end of the day, it's still multifamily. It's just a little bit of a different approach. So
exactly,
I understand what you're saying. I think it makes a lot of sense. I did want to ask you, because a lot of people, as a fellow California resident, a lot of people very negative on investing in California. Just like, oh, don't do it, don't ever, and you said, you invest in the Smile States, including California in that. And so I think, a lot of people would say that all the other parts of that smile make a lot of sense. But I think that it's probably good in a way for people that do invest in California. I think a lot of people's reluctance to invest here might open up opportunities for people that do, but I certainly know plenty of investors that invest here and are successful. So I wondered if maybe you would kind of touch on that, and maybe the strategy is a little bit different here than it might be in another state. But I would love it if you kind of give me your thoughts on that.
Sure. I would say, okay, I am a strong believer in California. I always have been. I understand the challenges that come with operating here in California, whether it's new legislation that can get passed, like up in LA, you guys had that ULA tax, the mansion tax that went into effect a year or two ago. That was a huge blow to commercial real estate values. AB 1482 that went into effect, I think that was during COVID or maybe right before COVID. That is basically a statewide rent control measure. That was, again, tough for value add players. I will say that when you look at the supply and demand dynamics in California, they remain strong. And they remain much stronger than those sweetheart Sunbelt markets. If you look at, even in LA, if you look at the supply versus demand dynamics in LA versus Austin, Houston, Nashville, Phoenix, it's not even comparable. So you got that. So I guess the challenge is just you have a lot of high labor costs, for example. Turning units. That's a big thing in LA, is turning units for renovations. It's really difficult to get people out and get into those units to renovate. You just have to know how to operate. And just with that ULA tax, you have to underwrite. I think it is 5.5% transfer tax if it's over 10 million or something. You just have to underwrite that. And we're looking at in the Bay Area actually right now. I wouldn't say in downtown San Francisco, but we like San Jose and some of the surrounding markets. Rents haven't grown a ton, but the lack of supply is, you still have a strong demand, and you've got very little shovels in the ground. That's why we love San Diego. San Diego's a tough market to get into just because of, very limited in transaction volume, and it's expensive. But there's really, vacancy in San Diego, and if you get outside some of those downtown San Diego has a ton of supply. You get outside of that, vacancy is almost negligible versus markets like Phoenix, where we're seeing 30. So I've gotten estimates all over the place, but I've determined that somewhere between 30,000 and 40,000 units are going to be delivered into Phoenix in the next 8 quarters. That's astonishing. And if you're going to buy into a market like that, you better be underwriting significant concessions, flat to negative rent growth. And so just the barrier to entry in California, it's tough to build. People want to live here. You live here, I live here. Sure, there's some politics you have to wrap your head around. There's some legislative hurdles you got to get around. But if you can make it work, it pays off. And if you have maybe you have to have a little bit further horizon on your deal. Maybe it's not a 3 to 4 or 5 year hold. Maybe it's an 8-year hold. But again, that thesis has been proven out time and time again. So that's my take on California. I'm a big believer. I understand people's hesitancy right now. I spoke to an investor, a big family office. I think they have like $1 billion in dry powder right now. And they said their investment thesis boils down to the redder the better when it comes to markets they want to invest in. So I get it. I totally understand that. But I think you can't write off California.
I completely agree. I think it's just a different way to operate. You've just got to, and like you're going to do things differently in San Diego than you would do in, the Carolinas or Georgia or whatever.
Yeah.
It's going to be a different way of operating. I think one of the interesting things, people always point to in California is that sort of tenant friendly rather than landlord friendly. And we invest in the other states that are landlord friendly and stuff. But what happens when the landlord friendliness changes in those states? Like that's kind of a thing that I think people leave out of that story. Or for example, like I know this because we have assets in Atlanta, but there's a big issue. They had the eviction moratorium during the COVID, and then that lifted over 2 years ago. And they still have an eviction backup because they don't have the infrastructure manpower to manage it. And so it's great to be landlord friendly, but if you're expecting those things to happen quickly and easily, and then they don't, that's going to place you in a bit of struggle. And so it's just like, I feel like at least in California, you already know that it's going to be hard to get people out. That it's going and people have strategies with cash for keys and things like that. You just like you said, with the mansion tax or whatever they call it, you have to, if you're planning to pay people to leave so that you can renovate those units in California, that's part of your underwriting. What are you going to give them? So it's just a different strategy. So I think
it comes down to skill set. It's really operator skill set in California. And I think Atlanta is a great example. That's a market we really like. Probably oversupplied in some areas, but it's okay. We still think it's got strong fundamentals. But we track bad debt market wide in Atlanta, and it has really crept up. It's a issue at the forefront, and it's because in my opinion, not the opinion of a company, but my opinion is that operators don't have that same California experience, whether it's the cash for keys or it's the different techniques that operators in California have developed over many years dealing with these kind of headwinds.
I think I completely agree, and it's something that took us some time. Thankfully, like I feel like we figured it out now, but now like when I look at new deals around Atlanta to underwrite, the first thing I ask for is, what's your outstanding bad debt? How many tenants, how much do they owe? How long have they been, in the eviction process? Because it's definitely, it makes a big difference. And I think there's a lot of, distress like that causes opportunity. So there's a lot of money to be made there. If you're buying a place and those tactics, like you mentioned, how to operate and use those tactics to sort of restore order, if you will, I guess, but just get things back, on track. I think that there is a lot of money to be made in operating those assets.
Definitely. And also I'd like to also point out that, every state comes with its own unique set of challenges.
Right.
Texas is a non-disclosure state. Estimating your taxes, your property taxes in Texas, is an extremely opaque process versus California. You know exactly what you're going to pay. In Tennessee, we have an acquisition right now in Chattanooga that we're closing in on, and you've got franchise and excise tax. So you have to come up with a creative structure for your entity to try to become exempt from that, to be exempt from franchise and excise tax, which are significant. So Florida, you've got insurance. Well, everyone's got insurance. But we have a deal in Miami and Jacksonville, and Miami insurance per unit's creeping up to $1,700 a door. So I would say that every state kind of has its own unique challenges. So you just got to pick your battles, I guess.
Right, and it goes back to what you said. You have to know how to operate in that location, right? And it's, I think that the challenge is always when things change rapidly. And it's the same thing. The whole market saw that with interest rates shooting up. But like you mentioned, insurance, insurance in Florida and I think Texas is experiencing similar things. But, if insurance rates are creeping up year by year by year during your hold time, okay, that's one thing. But like they pretty much tripled is my understanding. I don't have anything in Florida and Texas right now. And I'm happy that I don't, because that, like, the people that I know are like, our insurance, it's up to $1,600 a unit. Well, it was $600 a unit, something like that. So it's kind of, that happened very rapidly, and that's a hard thing to build into your underwriting. So
definitely
people purchasing in the future will know that, and they'll, plan for it. So it's just kind of,
and there's techniques so our assets in Florida, we rely on either our investment partners or our management partners. We use third-party management companies. So a lot of times our selection of our third-party management company will be whose umbrella policy will give us the best insurance rate. So I think that's an example. And if we have a deal with a large institutional investor, the deal in Miami, we're on their umbrella policy, and they have, a couple $1 billion in multifamily across the country. So because of that, that's that's a technique you develop.
Right.
Right. And so you just have to have the tool chest for whatever market you're entering.
Yeah. No, great points. I mean, I think it's just that's the whole job, right? As an asset manager is finding solutions, just finding solutions to these problems, and then sort of learning from them and implementing them in future deals as well. So I think it makes a lot of sense. Peter, let me switch gears. It's really fascinating, but I don't want to keep you here all day. Let me switch gears so I can ask you the questions that I ask every guest. First one is related to the name of the show, being Know Your Why. So what is your why? What's driving you? You've obviously had a lot of success. I think you've got actually a great story, sort of coming from that leasing agent and moving all the way up to the level that you're at now. But what drives you at this point?
Okay, so this is going to sound a little cheesy, but it's really enhancing returns to all of my stakeholders. And you have to think of that a little bit abstractly. My stakeholders are my investors, they're my tenants, it's my wife, it's my dog, it's my family, anyone who's got a stake in me. I try to, I feel, an obligation to try to benefit them somehow, which then in turn benefits me. So I think of, global or holistically, my stakeholders as whether it's my family, my dog, my friends, my tenants, my investors, my boss, my company, my coworkers. They're all stakeholders in some way or another. They've all invested at least some energy or compassion or love for me. So I try to enhance their returns. I know it sounds cheesy though.
No, I love it. I think it's that question often gets answered with family, which certainly, like, my family is at the center of my why. But I've realized that it also, I like sort of the way that you put it there, is, the stake, like essentially anybody who's invested in you in some way, right? And that's, like, you want, I look at it as like, yes, we want returns for our investors. We want them to make money. We also want our family, our mentors, our whatever, to be proud of us, like that sort of thing. All of that is kind of goes along with it. I like the way that you kind of summarized it all as stakeholders. It's a pretty good
A
perspective on it.
podcast host.
Right, right. Anyone, really true. It's just like who can we make, sort of
Yeah.
who can we add value to? So I think it makes a lot of sense. Um, Second question for you: what is something about yourself that maybe isn't common knowledge? A special skill, a hobby, anything that you'd like to share? Let people know you a little bit better.
Well, odd hobby I've recently gotten very into is brewing mead. So I've gotten very into it. Going to be entering my first competition mead soon.
Oh wow!
But I have a lot of hobbies. But anyway, that's the one that's like right on my mind because I'm bottling up a strawberry mead right now. I'm
Very
in
cool.
the second stage of fermentation. So I think that's kind of a unique hobby that a lot of people don't even know what mead is. It's fermented honey.
Okay.
So it's like honey wine, if you will.
Gotcha.
But
Okay.
yeah, that's a hobby of mine.
I was like, I don't really know what it is, but I mean, I've heard the word, but I didn't know it was fermented honey. I feel like you hear about mead in the movies about the Renaissance, like
Sure.
from years or centuries ago. So not something, I guess, that I would imagine it. When you say you're in a competition, I'm imagining you at like a Renaissance fair in the competition there.
It's I think there is a kind of perception of it being like a Viking. Like actually, this one recipe I made is actually called Viking's blood. It's a cranberry mead.
Yeah.
But it's an ancient alcohol, and it's fairly easy to make. I mean, really, the true ingredients are just water, honey, and yeast. But then you can get really creative and take it in all different directions. So I'm doing a strawberry basil mead right now. But it's really easy to make. You can buy kits online to get started, like basic kits, and get more advanced. So if you're looking for a new hobby, Jason, I would.
It's fascinating. It's fascinating. That's cool. That is like one of my favorite questions to ask people because some of the stuff is like just really interesting, like things I didn't necessarily know about or what. So I love hearing what people have going on, kind of outside their business world.
Yeah.
When people hear this and they want to reach out to you, what's the best way?
Best way to get in touch with me is by emailing me at peter@interwestcapital.com. I'll get back to you. One of our rules, my capital markets team, is to get back within 24 hours. So I will get back to you. Again, peter@interwestcapital.com. Any questions? If you want to get on our new investor distribution list, if you just have general questions or you want to discuss Mead, feel free to reach out anytime.
Yeah, perfect. We'll put that in the show notes as well.
Okay.
Last question for you, Peter. What piece of advice would you give to someone who's starting out? They hear this, they're inspired, they want to get into real estate. What would you tell them, as some first steps?
I would say it depends on where they're at. I mean, I think that the route I went is a long, somewhat arduous route to where I'm at right now. I think that if you don't have the time to do that, that's fine. I would say become an expert in something. And whether it's pick a market, I don't know, let's say you want Vegas. Understand every single fundamental in the Vegas market, what employers are hiring, how much they're paying. Just become a complete expert in that market and then jump in and just dig a hole. What do they say? Inch wide and a mile deep.
Yeah.
And just focus on that and focus on one asset class and come up with a investment thesis and try to make it work. And maybe during your research you realize that, wait, my office to multifamily conversions is actually a lot more difficult than I thought. Okay, we'll pivot. It is a lot more difficult than most people think. So pivot. And I think there's nothing wrong with pivoting once you have the full picture.
Yeah, no, I think it's great. I actually meant to. I'm glad you sort of reminded me this. I meant to sort of mention and highlight this towards the beginning. I love the sort of apprenticeship model to go get a job in this somewhere and just and figure it out. Like you'll learn it doing it. That's for sure. I think it's a really great step to take if especially if you're young and just starting out, and like your true your true value is your time, right? And you're at a point in your life where you can do things like that and go get jobs at exactly like you said in your story, you worked your way up into at a much bigger role.
Yeah, and also let me walk that back. I guess I was thinking through the lens of somebody, me, like in their mid-30s that wants to jump right in. If you are young and have a little bit of a runway ahead of you, I would say pick a great company and work for them, and pick a company that's going to give you reps. That's that you're going to, if you want to be in acquisitions or development, make sure it's a company where you're going to get plenty of reps. And even if you're not transacting that much, you're getting that exposure where it's an environment that is open to ask questions. And that I'm sorry, without a doubt, that's the best way to get in, is working for a great company, and learning what you love about them and maybe also what you don't love. And going from there.
Yeah, I think it's great. Well, Peter, this has been awesome. Thank you so much for your time today. Appreciate everything that you've shared. I think that the listeners are going to get a ton of value out of this. So thank you very much.
Great. No, this is fun. Thanks, Jason.
Yeah, absolutely. Folks listening, I know you're going to love this episode. Please like, rate, and review the show so we can get more great guests like Peter. And thank you all for listening.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?